Hi, everyone. Thank you for joining us for today's webcast, a closer look at gold and silver metals and miners, sponsored by Sprott. Today's webcast will provide one CFP, one IWI, and one CFACE credit. If you have questions on credit, please give us a call via the number on the console. We welcome and encourage your questions. You can type your questions in the Q&A box, and we'll do our best to get to as many of your questions as possible. Materials, including today's presentation, have been made available for download from the Documents folder at the bottom of your screen. We appreciate your feedback, so please take a moment to take our brief survey that is also located at the bottom of your console. We will cover quite a bit of information during today's webcast. If at any point in time you are interested in scheduling a one-on-one meeting with Sprott, please click the blue Confirm button in the meeting request box on your screen. Lastly, in the event you missed any part of today's webcast or simply would like to watch it again, a replay will be made available and all registrants will receive that information by email. I'm pleased to introduce our first speaker for today, Edward C. Coyne, Senior Managing Partner of Global Sales at Sprott. I will now turn over the webcast to Ed to get us started. Welcome, Ed. The floor is yours.
Great. Thank you, Gil, and thank you all for joining us for today's webcast, a closer look at gold and silver, both physical metals and miners. So I've asked John Hathaway and Maria Smirnova to join us today to talk about both physical gold and gold miners, as well as physical silver and silver miners. John Hathaway is a managing partner and senior portfolio manager at Sprott Asset Management. John joined us back in January of 2020 as a senior portfolio manager of the Sprott Concentrated M&A Strategy, co-portfolio manager of the Sprott Gold Equity Fund, and the portfolio manager of the Sprott Active Gold and Silver Miners ETF. John earned a BA from Harvard College and an MBA from the University of Virginia. Maria Smirnova is our managing partner and senior portfolio manager at Sprott Asset Management and has over 20 years of investment experience and joined Sprott back in 2005. Maria holds a Master's of Business Administration degree and a Bachelor of Commerce degree from Rotman University of School of Management from the University of Toronto. Once again, my name is Ed Coyne, and I'm a senior managing partner at Sprott, and I'll be walking you through today's webcast. From an outline standpoint, I've asked John to talk about both physical gold and gold mining equities, and then we'll turn it over to Maria to talk about silver and silver mining equities. I'll then briefly talk about ways to allocate to both the gold side of the equation as well as the silver side of the equation, and then we'll open it up for some Q&A with both John and Maria. For those that aren't familiar with Sprott, Sprott is a global leader in precious metals and investments. We have over 4 decades of experience and over 31 billion in assets under management. We're a publicly traded company and trade on both the New York Stock Exchange and the Toronto Stock Exchange under the ticker symbol SII. At Sprott, we offer a full suite of solutions, whether you want to allocate to the physical market, the underlying mining market or equities, as well as managed equities and private strategies. We have over 26 billion in both physical and ETF strategies, close to 3 billion in managed equities, and over 2 billion in private strategies. So for today, as we mentioned, we're going to talk about both gold and silver. And I've asked John to start off talking about gold. As many of you know on this call today, gold's broken out to all-time highs of over 3,000 an ounce. We think that could potentially continue as more Western investors or US and North American investors start to take notice. So with that, I'd like to now turn to John Hathaway to talk about both gold and gold mining stocks. John?
Thanks, Ed. We are in a new environment for gold and precious metals. And as Ed noted, gold has broken out above 3,000. It has been a top performing asset for many, many years. And now we have some help from the administration. And as you can see here, Scott Bessent, the Treasury Secretary, has held gold in his own account and that of his clients. and he regards gold as his top investment position. So can we go to the next slide? So year to date, gold is up almost 15%. Last year it was up 27%. I would say that these numbers indicate that gold is the slope of gold's advance has ramped up from what it was just a few years ago. And there are a lot of reasons for that. We know that, and as Ed already mentioned, there's a lot of central bank buying. That puts a bid under. This has all happened without participation from Western investors, and by that I mean North America and Europe. The evidence of that can be seen in the gold-backed ETFs, where they have essentially lost assets last year and over the last 5 years. And it would be my thought that if, for whatever reason, Western investors decide they want to participate here, and the allocation among financial advisors, and the latest numbers I have is 1%. That's the lowest it's been in 5 years. Just to change to 2% would be a tremendous inflow of capital into the gold space, and I think it would take gold several $1,000s higher. So can we move to the next slide? We love to show this, and I think a lot of people would be surprised. Gold has outperformed equities and bonds, and obviously the U.S. dollar, which is there at the bottom in the green, on the green line. Obviously, there have been periods where gold has gone dormant, and we're talking over a 25-year period. But still, I think this is a very impressive chart. Obviously, smart investors who have the ability to trade selectively may have outperformed gold. But I think for the average investor, this says that not having gold in a portfolio has probably diminished returns. Let's move to the next slide. This is just a depiction of central bank buying. You can see from this that it remains at a very high level. It's been there since 2022. One of the things that has activated central bank buying is the weaponization of the U.S. dollar as an aftermath of the Russian invasion of Ukraine. The investment in gold by central banks is really at the expense of U.S. Treasuries. That has potential implications at a time when the issuance of U.S. Treasuries is going up dramatically because of ongoing deficits, and the fact that central banks are allocating more to gold and less to U.S. Treasuries has to make you wonder about whether we'll soon see a resumption of yield curve control by the central bank, the Fed, to basically orchestrate the market for treasuries and keep interest rates down, which is what they were doing throughout the previous decade, from 2011 to 2020. We've gotten a little bit away from that, and interest rates have gone up. The Fed has obviously kept rates a little higher, but if the issuance of treasuries continues to be at this record pace, I think this will lead to renewed yield curve control, and I think that could add to another leg upwards for gold as Western investors seek the safe haven status of gold. Let's go to the next chart. To me, this is one of the most important charts of my part of the presentation, and that is that the growth of financial assets and government debt in particular has far outstripped the increased supply of gold, which, and we're talking about over a 40-year interval here. Gold, the supply of gold increases very, very slowly, roughly just slightly less than 2% a year. Whereas the issue with financial assets and government debt being a good proxy for that has increased at nearly 9%. And if you look at a 40-year stretch, 40-plus year stretch, that means there's a tremendous amount of assets that are held in the form of dollars that could, at any given moment, and for a number of different reasons, decide to migrate into gold. And the point of this is that the amount of gold available to absorb flows from financial assets is extremely small. And that is why I believe that the upside in gold is, and it's understandable that investors could say, well, gold's had a good run, maybe it's too late. And I would say to that gold is in a different regime today, in a different world, a new paradigm, however you want to put it. And once investors in our part of the world decide that they may want to have a bigger allocation to gold, there just isn't a lot of gold to absorb those flows. And that's why, to me, the price potential here has to be measured in the thousands of dollars. My friend Doug Pollitt made a great point. Actually, it was his dad, Murray, who said that when there is no liquidity, there's value. And where there's liquidity, there's no value. So there's liquidity in financial assets, and there's no liquidity in gold. It's probably worth speculating for a second on why investors would want to own more gold. And I would just list a couple of things. One would be that we could be entering a bear market. That's a matter of speculation. But if positioning, conventional positioning in equities turns out to be disappointing because of a bear market, that would be one reason that money could flow into gold. Another reason would be disappointment in Bitcoin. Bitcoin, and I'll go out on a limb here and say that Bitcoin is a speculative asset and very correlated with NASDAQ. So I think if NASDAQ has a comeuppance, and again, this is my point of view, it's a speculation, but if that were to take place, and Bitcoin and crypto were to be in some way impaired, I think that would lead to flows into gold. Again, it's a matter of speculation, but the point of this chart is that there's a huge amount of wealth that is contained in dollar-denominated assets. And if for any reason, and I've just suggested a couple, there's disappointment in the performance of dollar-denominated financial assets, one of the off-ramps, probably the most liquid off-ramp, would be precious metals, gold, and that would be gold. Again, I would say this is the most important slide in my part of the presentation. Let's go to the next one. Gold is hard to find. These slides speak to that. It's getting increasingly difficult to find large new ore bodies that are going to move the needle in terms of annual gold production. And equally important, a lot of the geology is located in parts of the world that are not safe political jurisdictions. There have been headlines about the jailing of gold mining executives in Mali, which is an important gold producing country in Africa. And new gold mines require lots of capital, measured in the billions. So if the rule of law is in question, which it is in many parts of the world where gold can be found, then capital will not flow in to build those mines. So that's another constraint in addition to the secular decline in the grade of gold that's being found. So supply and demand side for gold is very much in favor of restricted production, limited supply, and again, going back to the previous chart, that 1 or 2% annual growth rate may decline even further. So let's go to the next slide. One of the ways to get connection to gold, and again, I would say if one is positively inclined to the thesis of gold, gold mining stocks offer leverage to that point of view. Now last year, gold mining stocks using the VanEck gold mining ETF, GDX, did not really perform that well. However, there's a huge amount of disparity within that. And I'm not sure we have this in this presentation, but the top quartile of gold mining stocks gained substantially more than the 10.6% rise of 2024. And you can see again from this bullet point that this year gold mining stocks have started to come alive, again, this does not tell the full story because the top performing stocks have done better than the numbers in this first bullet point. Notwithstanding the fact that gold stocks are starting to perk up, they're still undervalued. They're substantially undervalued because they're trading at very low multiples of cash flow, and many of the companies are generating free cash flow yields of 10% or more. The surplus cash that they're generating is going to increase dividends and share buybacks. So we're beginning to see a return of capital to investors after a period of investment in new mines. So the industry is in a position to generate free cash flow, again, making the stocks an attractive way to get that connection to gold. Let's go to the next slide.
And hey, John, this is Ed Coyne. Before you go into the value of gold equities versus the bullion, maybe we jump to page 18 just to highlight what you were talking about as far as the disparity of performance and some of the top performers versus the other performers, and just highlight that a little further.
Okay, good. Thank you. Yeah, okay, because this is really important to know that a stock picking approach, which is what we employ in our investment approach, it can generate returns that are better than the, I would say, disappointing numbers for the VanEck ETF, which is a passive ETF, and therefore weighted to large cap stocks, which I'd say Newmont, Barrick being the biggest offenders, and misses out on the outperformance that can come from a stock picking approach. So Again, that's what we do. That's our specialization, and we've been able to deliver better returns than the passive index that we benchmark against, which is GDX. Let's go to the next slide. If there is a next slide. Well, the next slide is Maria, and she's going to talk about silver and silver mining equities. So over to you, Maria.
Thanks, John. But I don't want to take away from you because there were some slides. Heather, maybe you can reverse back to slide 16 or 15.
Okay, well, maybe we can go. I want to leave time for you. We can come back to some of them in the Q&A.
Okay, well, thank you for that. To the next slide then, slide 20. Thank you for tuning in. Today I will talk about how I and the firm, how we view silver. I wanted to talk about the attributes of silver, contrast it to gold, look at the supply-demand picture for silver, why we're bullish on the metal, and then I will jump to silver equities and kind of highlight why we're bullish on silver equities. So you will hear a lot of similar things to what John discussed with gold, but with a bit of a twist. So let's start with the basics. When we look at silver as a physical metal or something that is consumed, that comes out of the ground and consumed, it really has two sides to it. And the first one is similar to gold. It is a monetary asset. And I like to say it's the oldest currency in the world. So when we think about monetary aspects of silver, we think about consumption of coins, bars, ETFs, jewelry, those types of things. And that constitutes about 40% of the market. And when we think about the other side of the industrial side, that's about 60% of the market. And that's a lot in electronics, medicine, photography. Photography is defined a lot, catalysts. It's used in industry a lot, and it's used in a lot of various and very different end products. And I like to say it's used in small amounts and never to be seen or recovered, and never to be seen. So silver does differ from gold in that sense. It kind of has two heads. It's not just a monetary vehicle.
Hey, Maria.
Yes.
Can you improve your audio by any chance? I'm sorry to interrupt people, but I just would like Maria's voice to be a little clearer.
Can you hear me better now?
I think so.
Okay.
Apologies.
Yeah, of course. So the second point I wanted to make, and I will discuss this more, is silver has been in a structural supply-demand deficit. And like I said, I will expand on that quite a bit in this presentation. And the third point I would make is silver has higher volatility than gold. And the reason for that is the silver market is much smaller than the gold market. And John talked about how small the gold market is. So imagine silver is even smaller. So it's about 1 billion ounces of supply a year. Multiply that by about $34 an ounce right now. So that's about $34 billion. It's not a big market, so it is easy to push the price around. Now, that has benefits and drawbacks. In bull markets, silver actually outperforms gold by a big margin because, again, as silver's catching up to gold, if there's interest in the metal, it's like a smaller funnel. It takes fewer dollars to move the price. So let me go and expand on a bunch of these points. Heather, next slide, please. This is a chart similar to the one John showed with the prices of various markets going back to 2000. You can see silver, the gray line, has not performed. It's been much more volatile. It hasn't performed quite as well as the S&P 500, going back to 2000, but it's pretty much kept up. And what I would say year to date, things are actually changing. And it's interesting. It's an interesting change because silver is up about 16% year to date, while the general market is down about 13%. And more importantly, the silver equities are up 30%. So there's definitely a divergence happening this year, starting to happen, where the metals are and the mining equities are outperforming the general market and other investment type vehicles. Next slide, please. So again, to summarize our case for silver bullion specifically, silver is already doing okay. It's up. It's been up in the last couple of years. It is up again 15% this year, as I mentioned. And it is benefiting from that duality of being a precious and industrial metal, and it is in deficit. That's a very important point. I'll talk more about that. It is used in new technologies, so green technologies. It is used in solar, 5G networks, artificial intelligence, automotive electronics. So think about a car having various electric components. Silver is used in greater quantities the more electrification there is. So if you think about AI also, that's all electronics as well. So we'll need more and more silver going forward as these trends gain acceptance and pick up steam. Again, I'll talk more about this, but solar represents a very large component of the industrial demand for silver. It's about 16% of total silver demand versus 6% 10 years ago. And silver has lagged gold, as I mentioned. So it does have a bit of a catch-up to do. Next slide.
Hey, Maria.
Yeah?
Can you talk closer to the microphone? We're just getting a lot of feedback that people can't hear you. Are you speaking through your PC mic?
Yes.
Yeah. If you can get any closer to the mic.
Is this
Sorry.
better? Is this better?
Yes.
Okay. So this slide shows the gold to silver ratio going back to 1990. And you can see that this is something we look at just to see whether silver is overpriced or underpriced relative to gold. And it has fluctuated between about 40 to 1 to 100 to 1. Recently, it's trading around 90 to 1. Now, that just tells me right away we're trading at a point in time where silver is relatively cheaper than gold by a far margin. And in fact, we know also that silver is mined only 7 to 1. So silver has a lot of explosive power behind it. And I will talk about why we think we're at a time where we can actually see that explosive power come to fruition very soon. So in the next slide, I will talk to the fact that silver is a monetary asset. And silver does do very well when we are in a period of time where the Fed and other central banks are lowering interest rates. In other words, when we're in easing monetary cycles. You can see periods of 2000, 2007, 8, most recently last year. Silver does really well in those time periods. And we're starting to see silver perform well, but we're not quite there yet, I don't think. We are watching a certain level of price very careful, and that is $35 an ounce. And we think that if silver does break out, it already tried, by the way, in October to break out. If it breaks out $35, we're off to the races, hopefully. Looking at the industrial uses of silver closer. Next slide, please. The industrial demand of silver has been growing robustly, I would say, in the last 4 to 5 years. In 2003, it grew 11%, and last year was expected to grow another 9%. That's very important because prior to 2000, you can see that silver demand, industrial demand, was quite flat. It wasn't growing so fast. And so something changed. And again, I think it's the adoption of silver in electric vehicles, in solar panels, and the explosion of alternative energies. All of those things are contributing to and a speeding up of adoption of silver and this growth in industrial demand. Look, next slide, please. Looking closer at the solar market, so solar demand contributed about 200 million ounces of silver in 2023. That's 20% of supply that was taken up just by solar in silver. That's a very big number. And we do know, and projections are, and this is the chart I'm showing here, that solar installations are projected to grow quite quickly going forward as well. Global solar industry additions grew 76% in 2023. They're forecast to be another 35% in 2024. And longer term, closer to 30%. Those are the kinds of growth rates we're looking at for solar. China, of course, plays a big role in that. China produces a lot of the solar panels, and China has a lot of solar installed. But of course, it exports a lot of panels, a lot of glass. But China is taking up a lot of silver for the solar industry, and I will mention that silver does trade at a premium in China on the Shanghai exchange. It's about between 6% and 10%. Next slide, please. On the other side of silver supply-demand situation, the supply side, supply has been stagnant. Just like in gold, we have had a dire lack of new discoveries of silver deposits. Mining rates are coming down, which means the richness of these deposits has declined over the last decades. We're getting more countries that have longer permitting timelines. That means that it takes longer to explore and permit and build a mine. An average mine is probably over 15 years to build and discover and build. And that's all translated to a very flat to declining production profile for silver. You can see in this chart, we actually lost about 3%, or about, I think, 30 to 50 million ounces since 2015. And projections are for maybe a slight increase in silver supply, but not really a big pickup. So all of this has led to these supply-demand deficits. Next slide. So in the last 6 years, silver has been in a fundamental supply-demand deficit. And you can see that, 2021, 2022, 2023 saw an average of about 150 million ounce shortage per year. Those are big numbers. So rising demand, stagnant supply has led to deficits. So the next slide is my key point for silver. This has all led to a decline in above ground inventories or stockpiles for silver. And in the past, the pushback on silver has been, oh, well, there's a lot of silver sitting around in inventories. Well, that is changing fast. In the last about 5 years, we've lost about 400 million ounces of silver out of inventory. So you can see this chart measures stockpiles sitting in London, COMEX, and Shanghai. And definitely you can see a clear drop. And what's happened in the last couple of months with Trump talking about tariffs, we are seeing a movement of stocks from London to the COMEX. So London is blue, COMEX is gray. People are shipping metal from London to New York, and already about to the tune of 150 million ounces in the last 3 months. So that's just moving of supplies. But I think, and I believe, that these continuous deficits will draw down more of these inventories to the point where we will not be able to ignore the deficits anymore. And, the price will start reacting. These things don't happen overnight, of course, but I think that this will happen very soon. So to summarize the case for silver, I would say that watch the supply-demand function, watch the deficits, watch the inventories. Again, like I said, the price reaction has a bit of a delay, but it will happen. I will also stress that, again, while we haven't seen a lot of interest in the West, just like with gold, we have not seen too much investment demand. In fact, ETFs have been declining up until recently. We're seeing now a reversal of that. We are seeing some nascent Western interest, both from the macro trading funds and from ETFs. So plus still we're seeing strong demand out of India and China, out of the East. So all of this will translate to potentially very exciting moves in the silver price. Next slide, please. So let's talk about silver miner equities now. This is a relatively simple chart. The silver line measures the price to NAV. This chart, by the way, is provided by BMO Bank here in Toronto. So the silver line is the price to NAV, and the blue line is the silver price. And you can see, even though the silver price has increasing, the price to NAV has not kept up with the silver price. That's a very interesting phenomenon. Think that these miners would become more expensive with a higher silver price, but it's exactly the opposite. So I think there's just, again, that kind of lack of buy-in by the investing public into the fact that this is a real bull market and these equities have good fundamentals. And interestingly, we are starting to see more and more free cash flow out of these companies. We're seeing companies do capital return programs such as share buybacks and dividends. So we're seeing a lot of positive signs that the fundamentals of the companies are improving, making us optimistic about the prospects for the sector. And I have one more slide. Next slide, please. Just again stressing this point of fundamental improving in the sector. If you look back to 2020, spot silver price was it bottomed less than $15 an ounce, then it averaged about $20, I think, an ounce. So the profitability of the companies was not very high. This chart shows exactly that, the profitability per ounce of the sector. So it was about $4 profit per ounce. Not very good, right? But if you kind of fast forward to this year, and we're sitting with $34 an ounce silver, and the costs are, let's say, $20, your profit margin all of a sudden goes to $14. And that demonstrates the leverage, the financial leverage of the miners to the silver price. So I think the outlook for the silver equities is quite good. My message to the companies is always to watch costs and explore and find new ounces. And I will say these companies do listen. They do take what we say into account. And I'm optimistic that the sector is poised for a comeback of a sort and for a good rally. So with that, I will turn it back to Ed. Thank you very much.
Thank you, Maria. And before we go into how to think about precious metals, both from a physical allocation and a mining allocation, I do want to go back to John Hathaway's comments on supply demand and physical versus miners. I know, John, you had some similar pages to Maria as it related to both physical versus the equities, as well as opportunities there. So if you don't mind picking back up where we left off also on gold versus gold equities, I think that would be helpful for our listeners.
Sure, Ed. So this basically, this slide number 14 suggests that there's mean reversion potential. You don't have to get back to the ratios of 20 years ago. You could just go from the current 0.05 dislocation gap to twice that. And if you combine that with the improved fundamentals, the dynamics for the gold stocks could be. I have to tone down my rhetoric, but it could be spectacular. It's an opportunity, a stock picking opportunity that's just waiting to be taken advantage of. And I'll just leave it at that. But this shows that we've been through a period of maybe 15 years where gold stocks have been shunted aside because of all the excitement over the Mag 7 types of names, and I won't go harping on that. But it just seems to me that this sector, which has been neglected, in fact, the market cap of the entire sector is the same as Costco or Home Depot. So it's like 300 billion, which is in the spectrum of financial markets today, is tiny. And so it wouldn't take a lot of inflows into it to drive prices substantially higher. So valuations are compressed, fundamentals have turned very, very positive, and the stocks are very, very cheap. So I think in my many decades of investing, that's a combination that's hard to beat. So let's just wait and see whether that turns out to be the case. Let's move to the next one, please. Next slide. So I basically already talked about this, but substantial catch-up potential to bullion. Bullion has uncharacteristically outperformed the mining stocks. But you can see if you go back to over a decade ago, the stocks, as the bull market in gold, that first leg of the gold bull market matured, the stocks began to outperform the metal by a substantial amount. So we're way behind where we were 15 years ago. And I think, again, this just underscores the compression of valuation that the gold stocks represent, especially if the gold price, God forbid, goes another $1,000 or $2,000 higher, like I think it will. Let's go to the next slide. And here's just, this is just valuation. I mean, value very often is the formula for successful stock picking and stock performance. And these numbers speak for themselves, particularly the first one, which is the gold mining stocks are less than half the valuation of the average S&P stock, not even thinking about the big names like NVIDIA and all of those. So just the average S&P stock is more than twice as expensive on many of these metrics. And again, and then Maria touched on this, the profit margins based on current gold prices, and she talked about it in terms of silver, but it's true for gold as well, are dramatically favorable relative to the average S&P stock. And again, this means these companies are generating at these metal prices plenty of cash to buy back stock, increase dividends, and do other shareholder-friendly actions, which are not being priced into the sector. And I think that's it. Unless is there another slide?
Yeah, John, I think we'd skip over 18, which we covered, and just maybe finalize the point or hit the point home with gold miner valuations on page 17, not really reflecting the fundamental shifts, which I know Maria talked about as well. I think this is also a pretty eye-opening chart to express to our viewers, our listeners.
Yeah, and I mean, this again, this depicts what we've been talking about. I mean, the gold stocks, even though they're up 20+% this year, and last year a mixed bag, the GDX doesn't really tell the true story, but they're still pariahs in the world of equities. Very few people think about them, and yet if you have a bullish view of the gold price, which I do, and I've hopefully conveyed to you some of the reasons why. I like to use the term octane. They provide leverage to that directional leverage to a positive gold price environment. They have barely woken up. In fact, they're still almost sound asleep relative to what they could do as investors decide, well, gee, and if investors start to move into physical gold, which they haven't really done yet, and the gold price reacts in the way that I think it will because of the very limited supply of gold, then the impact on the profitability of the gold mining stocks, which has already been very, very positive, could be even greater. And so I think that I guess I would have to be accused, and I plead guilty to being a table pounder for the gold stocks at this time. I think it's a great opportunity. The world could shift. The Mag 7 stocks could do less well. Crypto could do less well. Investors might think, and FAs might think about repositioning more in the direction of gold. And I would say the door is wide open for very good returns if that all starts to happen. So I'll stop there, and hopefully we have some time for questions.
Great. Thank you, John. And thank you all for listening. Before we go to questions, I do want to just shift a little bit for you all who are listening to this webcast to think about how can you now participate in this from an investment standpoint. And, you know, when we're looking at both gold and silver miners, both the silver miners and the gold miners and the physical side have offered significant diversification relative to assets like the S&P 500, bonds, cash, and other assets out there. And we have seen that through multiple market cycles. And to John's point, you're seeing this asset start to reawaken from an investment point of view, whether it's the physical side or the equity side. And when looking at allocating to both gold and silver, the question has always been how much? How much should I allocate to this? Is it too much, not enough to have an impact? And it really goes back to looking at your risk tolerance or your investment objectives as an investor. But we feel that allocating to both gold and silver may offer diversification, may offer an inflation hedge relative to the overall economy, may also offer the opportunity to participate in the growing demand, whether it's gold as a alternative asset to your overall portfolio from a low-cost liquid hedge, to silver is a more opportunistic allocation to participate in silver's gradual and not so gradual move to the industrial side of the equation. And finally, from a physical standpoint, continuing to look at silver and gold as ways to get exposure to both from a sense of security standpoint and the intrinsic value that both those metals offer. So at Sprott, over the years, we've continued to grow from an opportunistic standpoint in the way you investors can participate in this space. And I am pleased to represent, from a gold mining standpoint, one of our newest ETFs in our extensive lineup, the Sprott Active Gold and Silver Mining ETF GBUG, which is one of my favorite ticker symbols these days. But effectively, GBUG is looking to give you long-term capital appreciation by actively investing in shares of gold and silver mining companies. And we've been off to a great start, albeit very short-term returns. The inception of this fund goes back to February 19th of this year. But year to date through yesterday, the fund's up a nice 8%. And we think this is green shoots into what we see as a long-term opportunity that John Hathaway talked about as relates to both gold and gold equities. And much like gold, we also have a similar opportunity in the silver space. And for many of the same reasons that Maria talked about as it relates to both the physical market and the equity market. And the Sprott Silver Miners and Physical Silver ETF, SLVR, which is currently the only ETF focused on providing pure play exposure to silver miners and physical silver. And we think this is also interesting, as Maria mentioned, because we see an opportunity both in silver continuing to hitch its wagon to gold from a monetary metal standpoint, but also silver expanding its use and the way investors look at it from a industrial standpoint. So we see tremendous opportunity in silver as well. And much like G-Bug, silver also, albeit a very short window here of performance, is also off to a nice start from its mid-January inception date of January 14th through yesterday, up over 20%. So again, we find both of these newer ETFs to provide green shoots into what we see as a larger thematic opportunity in both the physical market and the equity market. And this would be true both on the precious metal side, but also on the critical material side. We are seeing tremendous opportunity really across the board. So I encourage anyone on this webcast today who would like to learn more about Sprott as a firm and the full suite of offerings we have, whether it's on the physical side or the equity side, to reach out to our Sprott client service team, whether you're an individual investor, a financial advisor, or an institution. So with that, I'd like to pause and turn it back to Gil before we open it up for some Q&A.
Great. Thanks, Ed. As a reminder, materials can be found in the Documents folder at the bottom of your screen. We appreciate your feedback, so please do take a moment to fill out our brief survey, also located at the bottom of your screen. Our speakers will be taking advisor questions. Please type your question in the box under the slides window, and we'll get to as many questions as possible. In the event your question is not answered on today's webcast, a member of the Sprott team will reach out to you directly. If you would like to have a conversation to further discuss the ideas that were covered during today's event, please click the blue confirm button in the meeting request box on your screen. And with that, I will send it back to Ed for the Q&A.
Thank you, Gil. And I know we're running up on the top of the hour here in a few, so we'll try to get to as many questions as possible. I see a lot of questions that are product specific. What I will tell you on that in the interest of time is that we are going to be following up with everybody individually, whether it's through email or phone calls, and we can talk specifically about products and their structures at that time. But for more general questions, I think the first one I'd like to hear from both John Hathaway and Maria Smirnova, and that's really, what are you both looking at when looking at underlying mining stocks? Is it the cost per ounce? Is it the size of the reserve? Is it the location of the particular mine site? What are some of the key factors? Let's start with you, John, that you're looking at when you're looking at an underlying mining stock.
Well, you mentioned a bunch of things, Ed. Certainly location because of jurisdictional risk. We look at the quality of the asset, which would have to do with the economics, the mining economics, which has a lot to do with grade and costs. One of the most important things is management, and our team, Maria, me, and the others are very engaged with management through face-to-face meetings, periodic phone calls, because management can make a difference. It does make a difference. And I would say that's one thing that distinguishes us in the sense that we have a large group of PMs and analysts that are able to engage with management from the very top at the board level, CEOs and mid-levels, mine managers, and that sort of things, and geologists. So it's a pretty holistic approach, and all of the things you mentioned and then more are what we consider to be important in our stock selection process.
Thank you, John. And Maria, from a silver standpoint, is there anything in addition to what John had mentioned that's worth mentioning?
Well, I think John captured it well. I would say that we also focus not just on a point in time. We track companies through, throughout time, meaning we also look for the trajectory. If it's an exploration company, we want to figure out how big something can get, how good of a mine it can be. Is it a mine to begin with? And with a producing company, we look for trends in production. Is the company growing into production, et cetera? All of these factors. So it's a bit of a, mining is a tough business to look at because you have to look at many, many different variables.
Thank you. And John, let's go back to you for a moment. A couple questions are coming in as it relates to the divergence between the physical market and the miners themselves. I know you talked about this a bit in the presentation already, but let's talk about the cost of extraction. The question effectively is, is the cost continuing to go up? Is this going to continue to erode profitability, or have we seen that cost start to flatline as the price continues to go up? And what effectively the question is this: what has you excited right now as it relates to margin expansion in gold equity stocks? It was a long question. I was trying.
Yeah, no,
trying to summarize it for you.
No, I get the gist. Basically,
Yeah.
the rate of change in the gold price has been greater than the rate of change in the cost. So that's why margins are widening. Again, the dynamics of the physical gold market are such that with a small shift in financial assets from equities, from bonds into physical gold would lead to price increases of a significant order of magnitude different than the cost input. So yes, there has been inflation. Inflation is a fact of life. It's everywhere in the gold mining industry. It's everywhere in our daily lives. So there's no getting around it. But the rate of change in inflation for producing an ounce of gold is not keeping up with the rate of change in the gold price. So that, in a few words, that explains margin expansion, which is taking place. And prospectively, I would wager that, again, because of the dynamics of financial assets versus physical gold, that rate of change should continue to be greater than the rise in the cost of producing gold. So I'll leave it there.
John, another question that came in, we'll stick with this for just a second. Speaking of the cost of production or cost of extraction, what is that bandwidth? What are we looking at right now? What does it typically cost to bring an ounce out of the ground?
In terms of cash, it's probably, and the numbers vary from company to company, but I would say in the range of $1,000 an ounce. Maria, correct me if you disagree with that, but I would say the cash cost, more or less, is $1,000, $1,100. So the margins these days is $2,000 on just cash. Now, in addition to cash, there are other costs. We use all-in sustaining costs, which take into account exploration, depreciation, depletion, ongoing capital expenditures, home office, fully loaded kind of cash. And those numbers vary a lot from company to company, from mine to mine. But you're probably talking, on average, again, Maria, you have a very good mind for numbers, but I would say $1,500–$1,600. So still fully loaded, a wide margin of maybe $1,500 an ounce for the industry in general. Chime in, Maria, if you have any.
No, I think 15 to 1600 is a good number to use.
Great, thank you. And Maria, let's stick with you for a second. A couple questions have come in on the silver price. What we've seen is obviously gold hitting all-time highs. Silver clearly is a fair amount off of its high, but it seems to be stubbornly trying to break through 35. Any insight you can share with the listeners on what do you think can move that further along?
Well, like I said, the fundamental picture is longer term, the supply deficit. But in the shorter term, and this is something I'm watching, is emerging interest in the West. As I mentioned, we're seeing a turnaround in the trend of exchange traded funds. In other words, we're seeing inflows into the ETFs recently, which is very positive and encouraging. And we are also hearing about macro trading funds, CTAs as they call them, increasing positions in silver. So those are the kinds of factors that could move the price in the short term, and that that breakthrough through 35 that can be driven by these shorter term players in the market.
And we have one final question. This might be a subjective type of question, but I'm just looking at the volume of this coming in, and it's not going to ask you to dictate price or predict price going forward. But the question in general has been, we see margins expanding, we see all-time highs in gold, we see silver continuing to march forward. What will it take, and I'd like to hear from both of you on this, what would it take, in your view, with your experience, for the general market to start embracing this and start allocating capital to this space? John, let's start with you. You've been doing this for 4 decades now, or 3.5 decades now. What have you seen in the past that ultimately moves that needle?
I would say a bear market, in a word, bear markets, adverse experience in financial assets. And we know that can happen. We've had a terrific run in stocks for a bunch of years. If that stalls and reverses and turns negative, to me, that is a surefire formula for money finding its way into gold. And I would add crypto to that statement.
Thank you. And just for our listeners, we've seen more and more investors complementing their crypto allocations with gold. So they sort of live in the same neighborhood for sure as it relates to an allocation. So it's been interesting to watch that whole narrative evolve over the better part of a decade. Maria, on your side, silver, you mentioned a lot about silver and the industrial side of the equation. What do you think is going to keep supporting it, moving it forward, and having more investors start to embrace it?
Well, on the bullion side, as I mentioned, I'm watching the inventories, seeing how the deficits are translating of what's happening in the stockpile, et cetera. For the equities, I think if companies keep delivering and being consistent, and I use the word consistent a lot, being, consistently delivering on production, on free cash flow, on profitability, and not disappointing the market. If the generalists return, and maybe those catalysts that John described, of course they would help. We need the generalists to embrace the sector, and that'll take the valuations to a different level.
Great, thank you. And we could do this for quite a bit longer. There's, at most recent count, we have 118 questions, not all specific to gold and silver, but in general. As I mentioned at the start of the Q&A, we will be following up with everyone via phone call and or email. So I certainly appreciate everyone tuning in today. Thank you for your interest in Sprott's work, and we look forward to working with you all in the future. Thank you for your time.
Great. Thank you all for such an informative discussion today. As a reminder, materials have been made available for download and can be found in the Documents folder at the bottom of your screen. We appreciate your feedback, so please take a moment to fill out our brief survey, also located at the bottom of your screen. If you would like to have a conversation to further discuss the ideas that were covered during today's event, please click the blue Confirm button in the meeting request box on your screen. Thank you for joining us today, and enjoy the rest of your day.